This is an audio recording of the Lendit Fintech Weekly News Show. The show is streamed live on Lendit TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the Lendit News team and a special guest discuss the most important fintech news stories of the past week. Good afternoon, everybody, and welcome to the Fintech Nexus Weekly News Show. My name is Peter Renton, Chairman and Co-founder of Fintech Nexus, joined as always by Todd Anderson, my good friend and colleague. How are you doing, Todd?
I'm good, Peter. How are you?
I'm doing great. And back once again, we have Kat Utek from Core Innovation. How are you doing, Kat?
Well, excited for the fireworks this week.
Yes, indeed. We have some fireworks to discuss. So let's get right into it. The biggest news of the week, I think, is the crypto broker Voyager Digital, basically filing for Chapter 11 bankruptcy protection. They had a bit of a run on the bank, and the biggest thing they did, which in hindsight was probably the dumbest thing they did, was they loaned Three Arrows Capital $650 million, which I don't know if they got any of that back, but certainly not very much, as Three Arrows have been liquidated. And they're basically they got some money from SBF, Alameda Research, the Sam Bankman-Fried firm. They've just had a horrible time of it, and they are publicly traded on the Toronto Stock Exchange, but it appears that the CEO's putting on a brave face, and we're just reorganizing. We're going to get everything back. People aren't going to get all their money back, but they'll get a good chunk of it, get some equity in the new reorganized company, and off to the races we go again. So we'll see. What are you guys' thoughts?
Well, it's a nice spin to put on it, but clearly it's just another casualty in the contagion that's still taking place. And similar to Celsius and BlockFi, I think Voyager was 23-1 with their ratio. And so clearly assets to equity, yeah. And so obviously they got overextended, just like Celsius did, and then withdrawals came, and then Celsius news came, and then withdrawals came fast and furious, and they couldn't keep up. And so I think it's a big lesson that a lot of these companies are learning, which I hope others will heed in the future. Though it seems that some people will make mistakes regardless of what the lessons might be in the past. But there's going to be a lot of carnage still to come, and hopefully the crypto industry overall learns and comes out a lot stronger for it.
Yeah, I think the top two lessons, one is don't be over levered, and then two, customer concentration really does matter. You lose one big one and it might take you out.
Yeah, and that's really, who knows what would have happened if they hadn't gone through done the Three Arrows deal, but they did do it, and it's been ugly, and lots of there'll be more to come on that story as time goes on. But I wanted to get to another one, Kat, particularly get your perspective. The New York Times had a piece, I think it was just today, actually. Mm-hmm. Basically, it's not real news that startup funding is down, but they had some stats on it. Basically talking about investments in US startups plunged 23% from quarter over quarter. First 6 months, when you take it was obviously plunged in the first quarter as well. First 6 months, acquisitions and IPOs plunged 88% from a year ago. But the big thing here, and this is the thing that's different this time, is what it feels like. VC firms have collected $122 billion in new commitments so far this year. So, Kat, what do you make of all of that?
Yeah, actually, I had something from an investment bank sent me today, at least in the insurance tech startup land. It's down 60% since Q4 of 2021. So it's definitely down. And just anecdotally, me talking to GPs at other funds, think a lot of people are taking the summer off. So if you don't have to, I would not raise during the summer. People say they might come back in September. We'll see what happens and how strong it will happen. And I think valuations will be more normalized when people do come back. But we're seeing overall a big slowdown. On the M&A front, interestingly enough, I've talked to some of the big incumbents in people doing BD and M&A, and they seem pretty active. Now, I think some are hunting for deals, but there's still a lot of incumbents that have a decent amount of cash, that need technology, that during COVID realized that they really do want to go digital. So I think we'll see some interesting opportunities, maybe not at the valuations we thought they would be, but I think you see a lot of these, Series A and B companies that struggle to raise get picked up, and some of the later stage ones too. And I think there might be decent exits. I don't think anyone, not everyone's going to get killed, but definitely a slowdown on the investment front. I mean, then the other thing we're not really expecting is IPOs the rest of this year, or probably most of next, from all the banks and the analysts that I've talked to.
Right.
Yeah, I was just reading a piece on the train that basically the IPO market's going to be frozen. Maybe they're like, oh, maybe 5 deals will get done, maybe a couple more in 22, and even in the first half of 23. And I think a lot of companies, especially growth stage companies, looking for that capital to continue going, are going to be in a heap of trouble. I think a lot of what I've talked to, early stage startups and investors might be a little bit better off, but even then, it's not going to be a good summer, and hopefully things begin to ease a bit in the fall. But things are really hurting out there right now.
Yeah, what I try to tell some of the investors, though, I'm hoping people have more long-term thinking, right? Because people keep talking about this lasting maybe 24, 30 months. No one really knows. But eventually, I think the market will come back. I think we're hitting some of the lowest, lows. I can't see software multiples, being lower than the 4x that they're hitting around now. So I think if you take the long-term view, a lot of these startups aren't going to sell in the next 2 years. So if you have really good partners as investors, hopefully they'll support you so you make it past this. And then again, I really hope the multiples never go as crazy as they were in 2020 and 2021. But I do think there has to be some kind of normalization, and we might have went a little bit too extreme. So hopefully, both investors and entrepreneurs will get to more long-term thinking of where this is going to balance out.
Well, before we move on, Kat, just one last thing. You said like VCs raised huge amounts of money. I mean, what are they just going to be parking that money and deploying it much more slowly than they expected, and that they told their LPs they would?
I don't think so. You know what I think they're going to do is they're going to pour money into companies that they think are winners. And I think they might even double down on those winners and do even more than the Parada, especially now that, they might have been in at a cost basis that was like at a 20x multiple. Now they can get in at a 10x multiple and also support their company. And so I think it will all, balance out for entrepreneurs and investors. So I think there are going to be money for the best companies. I have seen a lot of inside rounds done, and not inside rounds done because the company's struggling. It's because the company's actually doing well. And we just want to make sure that they have enough runway, that can get them through that 2 or 3 years where they can keep their foot on the gas and not have to worry that they're going to go out in a bad market 18 months from now. So I think a lot of that money will be put to work, but you'll see it more in follow-ons than initial investments.
Right. Okay, so moving on, we're going to talk about FTX, the Sam Bankman-Fried's company, and not his investment company, his operating company. And he's basically this was an article in the Wall Street Journal this week. He's waiting on CFTC approval. He wants to basically start crypto derivatives exchange, I guess, a crypto derivatives operation, and he wants it to run 24/7. Clearly, this is not the way things have been done. He wants to do one without brokers, just dealing directly with FTX. It's a big ask to basically redo the way things have been done for decades, but they're pushing for it, and there's a lot of pushback from the traditional players.
I think it's also interesting the timing right now with all the other things that he's involved in, and they're not necessarily connected in terms of Celsius to what he's looking at here, but politicians and regulators connect these things partially for PR. And so I'd be curious how that plays into this. At the same time, this is a pretty entrenched market as is with how they do things. And especially in the story I was reading, I forget, maybe it was in the journal, with the brokers being the go-between and offering credit when someone has that margin call, and if this automated version doesn't allow for that, and what that might mean for the market, and kind of the gatekeeping aspect of brokers and the power they have. I'd be surprised if this just gets greenlit without some conditions or changes. But I think it's interesting, kind of all these different pieces playing right now, especially with how much he's had to step in with the crypto lenders at the same time.
Yeah. I mean, again, he's a guy I wouldn't want to bet against, but you do have a lot of people highly incented to not see this go through. So I think there will be challenges. And especially in the market we're in, you're watching a lot of end consumers, and institutions, which we just talked about, blow up, that you might not see the CFTC or any regulatory body be that excited to start trying new things, especially when the incumbents are screaming, they're taking on more risks, they're taking on more risks. So, I think he might have an uphill battle for a bit here.
Yeah, it'd be a ballsy regulator to just get it to green light this without any kind of, given what all the blowups that are happening. I read somewhere this week too that SBS net worth has gone from 26 billion to 8 billion in the last 6 months. So, it's still 8 billion's
okay.
8 billion is still good, but not what it used to be. Anyway, moving on. I want to talk about the crypto lender Nexo. We had Vauld, which is a smaller crypto lender. The crypto lenders are just really struggling. Let's just face it right now. We've got obviously the Celsius news and the BlockFi news, and now Vauld is really struggling, and Nexo's trying to pick them up. They've got a 60-day, they've got a term sheet that gives them 60 days exclusivity to negotiate a deal. They're starting their due diligence, and it's apparently Nexo also tried to buy Celsius but couldn't get that deal done. They clearly see a way. They're well capitalized, it seems, and this is a way for them to pick up some great deals.
I think the crypto lending market's going to look a lot different.
Mm-hmm. It already does.
It does now, and I think the way they operate in the future is going to look a lot different too. I think you're going to see some material changes into how they operate, and that'll be good, I think, at least in the short term, and see if they continue those practices long term. But clearly, like Anthony of Nexo said, there'll be fewer companies, but a lot of those fewer companies will probably be stronger companies at the same time.
Yeah, it'll be interesting to see what happens to the interest rates, right? Like, it seemed a bit too good to be true that you could get 7% returned without taking on any risk. So I don't know if they're going to come anywhere close to the rates that they were able to provide. And clearly there was a lot of risk because a lot of people can't get their money out, which I can't imagine how frustrating that must be.
And that's what's had the Wild West kind of feel to it. I remember going into some of these things. I remember like Luna talking about 8% returns and on a stable coin with very little risk, controlled algorithmically. And I mean, I actually, I almost pulled the trigger on that to buy some myself, and because it sounds compelling, but it's really.
I mean, even if you look at like Voyager, in some of their marketing materials, they were basically implying that they had FDIC.
That was terrible.
When you looked at it, it was only if, I think, Metropolitan or whatever the bank that they're using, it's only if that bank failed, not if Voyager failed. So if Voyager failed, your funds were gone. But they implied the other way around. Yeah. And so you had a lot of this bravado as well. And in reality, when the crap hit the fan, a lot of these companies went under pretty quickly.
Yeah, I feel bad for a lot of the people that really didn't understand what they were signing up for. It's kind of like there's no free lunch. I try to think about like the plus side of it is now, especially there were like a lot of young kids that were invested in this. I think they learned a good lesson that like, there's not return without risk. And, hopefully this makes all the young adults that were invested better investors kind of going forward.
Yeah, I mean that's the lesson. I mean,
Some good case studies for schools.
You read this. I mean, you read some ridiculous stories of people having like $2 million, like a 22-year-old with $2 million worth of Luna, and that was 99% of his net worth, and now it was worth zero, sort of thing.
Yeah.
So hopefully they've learned a lesson. Anyway, moving on for another company that's learned a lesson, hopefully, is Meta. Meta this is an interesting saga. It's been going for 4 years, 5 years. Meta, Facebook, basically announced their digital wallet, digital payment system, several years ago, and now it feels like that whole chapter has come to an end. They've pulled the plug on Novi, which was their digital wallet. They may be using the tech in their metaverse type product, and that's to be determined. But I can't think of a more mismanaged project than what Facebook sort of went through with their whole kind of digital wallet experience.
Yeah, I mean, I appreciate people taking on ambitious challenges, and they did, and they tried to rise to the occasion when it seemed like there was going to be a market there, and they figured they had such a great population of people to get them to roll onto a stable coin and use it. I think the intentions and the overall thesis was good, and then clearly it didn't work out. Now, was that because of execution, or there really wasn't product market fit there? I'm not sure, because I wasn't that deep into it. But they did grab some great people around that project, and I think if you're watching Meta lately, clearly they have to innovate in certain ways, and so they might try things, and at least they know when to pull the plug if it's not working. And honestly, it seems like they maybe should have pulled the plug a couple years ago after some of the main people that were working on Libra left. That could have probably been a good sign that it really wasn't working. But good to see them try to do something new.
Yeah, that's a good point, Kat.
Right. It feels like they went the opposite way around. Huge fanfare instead of maybe like a pilot project with some of the names. Do it small. If it proved out, great, and then blow it up from there. But they went for the big home run, and they swung and missed. And I'm sure they're gonna, the tech that they've built, I'm sure will be used in some capacity. It's not like they have idiots over there.
Yeah, and that's the thing that they had some good partners when they launched. I remember watching, like, they had like an A-list partnership when the Libra sort of first launched, and it
felt like they did it without like at least alerting regulators at all, because it was like a week or two after regulators, I think, came out with a statement or said something, and a handful, I think it was 4 or 5 people pulled out like in that first few week period. It feels like there was some early missteps that maybe they could have managed a little bit better.
Yeah, they did attract some great investors. I know we had spent time looking at it and ended up not getting it. I don't know if you recall. I think you invested $10 million and you got something for it. And they attracted some of the best fintech investors. I think it was an ambitious project. In hindsight, I'm just happy I didn't invest in it.
Right. Okay. Also in the Wall Street Journal this week, Klarna. Now, Klarna, the news goes from bad to worse for Klarna. I mean, they raised at $45.6 billion valuation in 2021. At the time, I think we talked about that, saying that's crazy. It's not sustainable. They initially went out for this latest round with a $50 billion valuation, then 30, then 15, and now it looks like 6.5 is where they're settling at. $650 million. Led by Sequoia, mainly from existing investors. It's I think they probably. I feel like at $45 billion valuation, I would have hoped that they could have stayed away from the markets and just tried to ride what they raised last year. But they're growing fast, and I see Klarna everywhere. They are absolutely everywhere. And clearly they've they're growing rapidly, but boy, it's a blow for employees and existing investors for sure.
Yeah, I think a lot of the investors will end up okay, right? Obviously not the later stage ones. They got caught up in the hype, but those guys are probably in some other deals that are fine. I really do feel for all the employees. And right, it's just not at Klarna, it's at a lot of these companies that are down, 80 to 90%. And I think people might have thought a correction, but it would have been hard to predict like this much of a correction. So for those people, I think it ends up being a boon though to the earlier stage tech ecosystem, because people are jumping ship from companies like this and going into earlier stage companies, or to companies that had more reasonable valuations. This might be, I feel like this whole episode should be called Lessons Learned, and we could have went like 1 through 100. You could have ordered it like there, but this might be where, the turtle wins the race, and it was like slow and steady. And you watch a bunch of companies, and even in the BNPL space, that literally had CEOs going, okay, yeah, we should be valued more than a lender, but should we be valued like 10 or 20x times like a typical lender? And that was, the valuations were a bit egregious. So I think those that were slow and steady and that were more valuation sensitive, but to be more conservative, I think they're going to end up winning here. And so, again, it's a good lesson, right? Sometimes you're on top, sometimes you're not, but being a good partner all the time and knowing that this is like a long game and not like over optimizing for short-term hysteria, both on the side when multiples are going up or right now when multiples are going down. I don't think investors should be completely taking advantage of the situation. I think it should be like, let's be a good partner. Sometimes things are going to be up and sometimes things are going to be down. So yeah, it's real tough for the employees, but hopefully Klarna will get back to work and that they'll be able to, they've already built something pretty special and they'll be able to move forward from here.
Mm-hmm.
I think it's also a good lesson for some of those executives when it's like, all right, let's expand to this, that, and the other. It's like, all right, maybe we'll do this expansion versus, expand to 5 or 7 markets. We'll do 2 markets. And so I think some of that stuff could be a good lesson for some of these companies as well, because it's like, grow. And,
it's easy to say that, Todd, but when the money's there. And
in
the money's
it's impossible not to say, wow, 45 billion, we need to do this. I mean, it's, it's always hindsight that we're talking about.
Right. Stuff. Yeah. Okay, moving along, I want to talk about column from Dave Birch, who I follow. He writes in Forbes, and I've met him several times. Really, really interesting guy, particularly when it comes to talking about digital identity. But he writes about DeFi, and there's been a lot of DeFi have actually come through. True DeFi has come through this kind of challenges of the last few months fairly well. And he's talking about tokenization, basically tokenizing real world assets. He said could bring trillions of dollars into DeFi. But we're going to need new identity infrastructure. We're going to need, the whole kind of raft of compliance type, compliance layer, shall we say. And, transparency is one of the great things, but there also needs to be privacy. You can't have businesses don't work on things that are being completely transparent. So his point was that when all this settles, the technology is fantastic and is going to change the world.
I mean, a lot of the issues that we've been talking about with some of the crypto firms, these are people issues that made decisions to put money in instruments that were not liquid or, over levered the company. I mean, if you look at the technology as the baseline of understanding, it's not like the technology itself failed. And so I think we need to sometimes separate the two. But, maybe this is going to be slowly becoming the age of rake tech, because there's so much that still needs to be done there, especially with identity and everything that, before we adopt it at large scale, which is potentially what Dave's talking about here. It's not like we can just jump there from where we are today.
Mm-hmm.
Yeah, I agree that a lot has to be done with identity. I do wonder how much can be done that's truly decentralized, mainly because if you saw the government came out, I can't remember which organization it was recently, saying that there's going to need to be one party that's responsible. And just given watching all the collapses, at least there are people that can be held accountable if what they did was like wrong or illegal. And if you're truly decentralized and you don't have that person to be held accountable, I don't understand how the government's going to, how that's going to fly. Now, what can they shut down and what can they not? I think they can make lives difficult. And we're watching this all the time when people are trying to do interesting things like SBF and the government just says, no, you can't do it. We've watched companies leave the US and go out of the country when the US is just like, no, not happening. You've watched India and China shut down a lot here, and you've watched other countries like Singapore really get ahead. And it'll be interesting to see if Singapore like switches tunes too, because they had a couple of their companies go bankrupt, and that's not at all how they want their country to be portrayed, of people that are entrepreneurs not being good stewards of capital. So I really do wonder of how decentralized organizations really can be, and what the government's going to do to kind of prevent them not having any control of someone being accountable.
Yeah. I mean, that maybe
recourse is big.
Yeah, that's a really good point. Really good point. Just before we go on, I just a quick plug. I interviewed the CEO of, I don't know if you know, Securrency, securrency.com. I interviewed the CEO on my podcast this week. It's coming out a week from tomorrow, and boy, are they an interesting company. They have really focused all on the compliance piece and have pretty much solved it. And for DeFi, they think so. Really interesting work going on there. Anyway, let's move on. Another Forbes columnist, a good friend of the show. He's been a host several times. Ron Shevlin. How banks can compete in the post-neobank era was his column this week. And he basically says that, the old paradigm for banking, attracting deposits through branches, and that's obviously gone, and it's not coming back. But he's saying what's going to replace it, and he basically says there's two strategies that is going to really make an impact on banking, and that is, first is what he calls embedded finance. That's banks offering their basically offering their services through third parties to attract large numbers of new customers at a low cost. And then the other piece is what he's calling embedded fintech, which is sort of the opposite thing, and having banks basically partner with fintechs to offer the fintech services. So he says they need to have a strategy for both, and they need to basically, have what he calls a targeted, embedded finance strategy, and that's what he thinks is what's going to save banking. So, thoughts?
I feel like compared to some of these neobanks, the traditional banks are looking okay these days. But I do. We kind of always believe that partnering with a lot of these banks seem to be the right way to go, both for on the startup side, so they can get business, and a lot of these banks do have like long-term relationships and access to a lot of customers. And then on the banking side, it's just ways for them to monetize their customers more. If they have the infrastructure and then they can partner with others, again, another way to monetize what they already have. So I thought it was a great, article and great points that startups and banks and credit unions, whatever, are all going to work together. And I think it'll create a bigger pie for everybody.
Mm-hmm.
I think now is the kind of the perfect time to do it, because there's going to be a lot of fintechs that might be hurting in their traditional business model, and finding different ways to work with banks and maybe get acqui-hired or something along those lines, where the company doesn't necessarily go away, but lots of pieces of it are acquired by a bank, and then they can figure out ways to either use the technology or embed the tech. It's a natural evolution and where banks need to go.
Okay, so we're going to close it down this week with a story about Goldman Sachs, and it's about the new the exodus of people from Goldman Sachs. We're talking about the new Walmart Ribbit venture that's now called One. That's in capital letters, ONE, and they've hired 5 people directly from Goldman Sachs recently, just in the last couple of months, and they've had 4 who used to work at Goldman Sachs. Now, keep in mind the head of one is Omar Ismail. I've actually been emailing him back and forth. We're trying to get set up a time to chat because I want to. I've known Omar really well from his days at Goldman Sachs. He's spoken at our event a couple of times, and we're really interested in what he's building, and he's building something big, and he's building it. It looks like with some of his old buddies from Goldman Sachs.
Yeah, I mean, we love One. We'd initially invested in it before the whole Walmart Ribbit JV, and I think it's a really fabulous team. What they've built is great. If you don't have the card, I have it. I think it's wonderful. We've been testing it for a while, so it's great to see them pick up more talent. And I think, Walmart, they were always one of the biggest providers of financial services. I might have said this before, but Walmart is the largest check casher in the U.S. and also does it at the cheapest rates than anyone else. And per square foot of their store, I still think that's their most profitable per square foot where they sell financial services. I know with Green Dot, it worked really well. So they have access to so many people, and they definitely have the breadth. So I'm excited both for the One team and also just for the general population, because I think Walmart can do financial services well and probably cheaper than anyone else.
Right.
Especially for those that live kind of near the edges of, the pay scale. And when it comes to that type of income, you need financial services that are infinitely more cheaper than what a traditional bank can offer and what some other offerings cost as well.
Right,
yep.
Right. Anyway, we are out of time. We need to wrap it up here. Thank you, everybody, for listening. Thank you for your comments. Sorry we couldn't get to your comments here. We will be back same time next week. Thank you, Todd. Thank you, Kat. And see you next week.
See ya.
Yeah. Thanks, Kat.
Thanks. Bye, guys.